Hello everyone and welcome to this first of a series of videos on the subject of bookkeeping targeted at real estate investors. If you're like me, when you started, you read some books, spoke to people, got really excited about going into real estate, perhaps save a bit of money and run out and bought your first property. And before long, you realize you're drowning in receipts and buried in running your business. And so you're facing the typical challenge that most real estate investors face, which is that instead of growing and scaling up their business, they find themselves just struggling to keep up with all the demands of running the business, bookkeeping being one of them. This series of videos is intended to actually talk about how to think about organizing and bookkeeping your business and then following through with that so that it makes life easy at all the subsequent points, whether it's during tax time or talking to your banker or talking to investors and whatever. When you keep books properly, it makes everything else go well in your business. Now, I remember when I ran into this anecdote about the famed investor Warren Buffett, and it was said that he would buy multi-billion-dollar businesses without even taking a look at them. And I used to wonder why. I mean, how is it possible for anybody to do that? The answer is really very simple, and it's that the books of a business tell the story of the business. Now, assuming that those numbers in the books are correct, so one could, in principle, understand fairly well how a business is doing without actually going into the details of what the business is or what it's doing, right? You can actually just look at the accounting for the business, and over time, if that's done properly, you can get a very detailed and good sense of how that business is doing and what are its prospects. So this video is intended to show you how to think about it first and how to do it subsequently. Okay, so let's get started. So there you are, an aspiring business person. Again, you've read all the good books on real estate, tells you what the potential of the business is. You've spoken to friends who are involved in the business, and you are very excited about getting started. And so, of course, the first thing most people do is that you save a bit of money. I'm not saying you need money to start in real estate. I'm just saying that's the conventional way most people do. So you have a day job today, you save a little bit of money, which we'll call capital in this case. And at some point, for your market, you think, okay, I have about $25,000 in savings. I'm good and ready to start my real estate business. Okay. The very first thing, before you even own a property, the very first thing you need to start thinking about is to acknowledge, first of all, that your new business, a new real estate business, is going to have a financial life that is very different and independent of yours, right? This is a concept that most people, at least not new business people, don't actually pay enough attention to. Is that your business exists independent of you. Now, there's a relationship between the business and you, and that's an ownership interest. But you have to think of the business as having its own life, its own financial life, and that's what we are here to talk about today. Okay, so there you are, and you have your $25,000 in capital. And so this $25,000 need to be invested into your business. That investment contribution in return gives you an ownership stake in the business. Most of us understand what this is, and typically it's called equity. And in accounting, that's also the name for it. Okay, so we have designated in this case, this dotted line is meant to represent the entirety of your business, the financial life of your business. What we are going to see in the subsequent views of this video, that money is going to flow into and out of your business. And the key word here is flow. Okay. You will find out also that there are no miracles in business, right? Money cannot simply appear or disappear. It has to flow from somewhere to somewhere. And the whole point of accounting is to make a consistent picture so that one can follow this flow of resources into and out of your business. The very first flow, in this case, at the creation of your business, is a capital flow. You need to contribute that capital to the business. And the rule of thumb we are going to establish here is that every time something crosses the boundary into and out of your business, it needs to be checked in or checked out. Okay, so starting with your equity contribution, it's going to flow into your business. So it needs to be checked in at the equity door. Okay, so the smart thing you do is, and by the way, all of these checkpoints that we are going to discuss in your business, these are just accounts, okay, on paper. There could be something that you create in the software, in an Excel sheet, or even just in a piece of paper if you are very old school, okay? So they are representation of flows um, that go into and out of your business. The very first one, as we said, is your equity contribution, which takes the capital that you have saved. So that capital flows into that equity checkpoint, gets checked in at $25,000. Now, as we said, these checkpoints are just representations of the flow. Okay, it's not where the money actually resides. So once checked in, that money gets moved into an actual checking account. And that checking account needs also to be represented as on the piece of paper as a checking account, right? So that's actually what holds the assets of the business, right? So notice two things here. This single transaction of you contributing $25,000 to your business has been recorded in two places. First, as the check-in point, which is the equity check-in point, and then subsequently into the account into which it was deposited. In other words, that's a real account. You've gone to the local bank and you've created a real account. But now you come into your accounting system, again, piece of paper, Excel sheet, or some professional software, and you create a representation of that physical checking account. And also that's where you record that $25,000 as an asset. Okay. So now you have your business operational and your business has some assets ready to be deployed. Okay. So with that readiness, you go out and you start looking at property. Okay. You look at a ton of property, run your numbers, and then you finally settle at a property you like called 123 Main Street. The problem is 123 Main Street costs $100,000 and you don't have $100,000. So smart business person that you are, you run over to your local bank and you talk to your banker and you let him know that you are interested in going into real estate. You have saved up some money in your business account, and you have this property that you are interested in buying, and it costs $100,000. So you proceed to show your numbers, including the numbers that you have made for rent and expenses, and you show and prove to your banker that this property will be profitable if they would let you buy it. Your banker looks at your numbers and agrees with you that indeed these numbers would work to your favor in terms of generating a profit, and so he agrees to lend you the remaining of the money that you need to buy the house. In this case, he agrees to lend you $80,000. Okay, so with that pre-approval, you now proceed to do all the due diligence that you need for the property and go to close. On the day of closing, you get out, everything is still well, you go to the title agency and you close on that property. And at the end of the day, you have a property that is worth $100,000. You maybe paid $2,000 in closing, so you paid a total of $102,000 for that property. Okay, now let's look at it step by step in terms of what actually happened so that this transaction can be acknowledged in your accounting system. Okay. What actually happened is that once you sign on the dotted line at that closing, acknowledging that you have taken a loan for 80,000, you are indeed on behalf of your business agreeing to take on a liability, right? Something that the business owes. Okay? As we said, everything that checks into the business or out of the business needs to be checked in or checked out at an entry point into the business. In this case, that needs to be a liability checkpoint. Okay, so the $80,000 that you agree to take on as a loan in the bank, what you are doing is you are taking on that 80,000 as a liability. So you check in that money at the liability checkpoint. So it's recorded there at $80,000. Then the actual physical money gets moved on to close on the property 123 Main Street, right? So now that Main Street property has checked into your business as an asset, right? Remember, it had to come through the liability checkpoint. But of course, you don't need only $80,000 to close on the house. You actually needed $100,000 and maybe $2,000 more for closing. So what you did, you also signed in paying a down payment, you signed over a check from your checking account for $22,000, right? So you remove $22,000 from your checking account and that value got transported over to the house, which is 123 Main Street. So in summary, this is now where your assets for the business lie. In your checking account, you have $3,000 left over, and now you have a new asset, which we will designate as 123 Main Street, which a value of $102,000. Now remember, this value is not the value of the house. In the accounting that we are doing here, we don't care about the value of the house. What you care about is the cost, how much it costs you to buy whatever that asset is. Okay, that's what we're going to keep track of. Okay, so let's now look at overall what has happened so far. Okay, we know that in the transactions that we have done so far, we've wound up with a couple of assets, right? A house that cost us $102,000 and $3,000 left over in the checking account. So under the assets column, we have a total of $105,000, right? We also acknowledge that in order to get to those assets, we had to borrow $80,000 in liability. Now, if I subtract the liabilities from the assets, I wind up with the initial equity that you contributed. Now, I see that there's a balance in how these various accounting buckets relate to each other. In fact, that's where the word balance sheet comes from, okay? Because it depicts a relationship between your assets, your liabilities, and the equity. What it's saying is that if you take all the assets of a business and you subtract from it all the liabilities of the business, then whatever is left over is the equity interest or the ownership interest. The owners of the business have a claim to that amount. In this case, we haven't actually made any transaction that changes any of these values, right? We've just moved money from one bucket to another. So that's why our equity stake is still our initial $25,000. Okay. But of course, nobody goes into business just to move money around, right? The idea is actually to generate money through the business. So there is some other aspect of the equity thing that we haven't talked about, and we're going to look at that in the next several minutes. Okay. So let's get back to it. So at this point, you have a house. Okay, you bought the house in move-in condition. Everything is good and ready to go. So you just now need to look for a tenant. And so you go over to Craigslist or any of the advertising platforms, and you advertise that you have a nice house for rent. Okay, it's going to rent for $1,000. And of course, you with such a nice house, you get a ton of applicants. And being the good landlord that you aspire to be, you proceed to carefully screen your tenants. And after going through all the screening, you settle on Bob. Okay. Bob has a good job, makes a good income, has good rental references, and so you think Bob will be a good candidate to become a tenant in your house. Okay. In order to get to that tenancy, Bob agrees to pay you a rent of $1,000 as well as a security deposit for $1,000. Okay, and proceeds to write you a check for that. Question is, how is this transaction received into your business? Okay, so as we said, everything going into and out of the business needs to be checked in and checked out. Rent, of course, is income. Okay, so we need to create an income checkpoint. Okay, and that's what we do here. And we proceed to check in the rent paid by Bob. We record it at the checkpoint, acknowledging that Bob has paid us a rent of $1,000. And then you proceed to move that money into the checking account where it resides as an asset of the business, right? Once again, we have recorded the transaction in two places, at the check-in point and where it winds up finally, okay? So again, remember the concept of a flow. So we've now concluded the transaction for rent. Now let's see what we need to do with security deposit. Now the security deposit is actually kind of an insurance policy that you are requiring Bob to make, right? What is indeed is that you are saying if Bob were to live in your house for whatever the term of the lease is, and at the time that Bob is leaving, if he would return your house in somewhat similar condition as it was when he got in, then you will return his $1,000 security deposit. So in other words, that's the money that your business owns. It's just money that is being held until a certain condition is met. Now, when you are holding money that you intend to give back, that means you are owing that money, okay? And when you owe something, it is a liability. So clearly, we need to check in the security deposit at the liability door. Okay, and so again, we go in, we check in the money, you see $1,000 of liability recorded, and then now we move that money into the asset of the business. Okay, now, but we cannot put this money, or at least it's not advisable to put this money in the same operating account where your rent and other capital is residing. Why? Because you want to be able to hold the money that you, for example, owing people where it's safe. And in fact, in some territories, this is required to be separate and interest bearing. Okay, so you run down to your local bank and you create a second account, which is called an escrow account, right? And into that account, you deposit the $1,000 that Bob gave you. Once again, we have recorded this transaction in two places. First, at the check-in point, acknowledging that it's a liability, and then finally where it resides, which is the escrow account. Okay, so now Bob moves into your house and starts his tenancy, and everything is going on quite well. 2 weeks after moving into the house, Bob calls you up and says the faucet is leaking. That's okay, right? Although you bought the house in move-in condition, doesn't mean everything was new. The faucet happens to be dated, and soon after Bob started using it, it developed a leak. That's fine. Now, being the good landlord that you aspire to be, you go out and you shop for contractors who can help fix the problem. And you talk to several people and you settle on Joe. Now, Joe quoted you the sum of $250 to repair the problem. And again, a savvy business person that you are, you negotiated the price down to $200 with the agreement that you will funnel all your future business to Joe. Joe likes this idea and agrees to do the job for $200. You also happen to, being that this is the first time you're working together, you agree that you will pay Joe after he has completed doing the job. And he agrees to it because he likes doing business with you. And so Joe proceeds to do the job, gets the job done, and then it's time for you to pay him his $200. Now, that money has to come from somewhere, and it has to come from inside your business. Now, so far, everything that we have recorded has come from outside flowing into your business. This is the first time where actually money has to come from inside the business flowing outside. Now, Joe is not part of your business, he's outside of your business. Okay, so that money has to come from your operating account, which is where you hold all the operating assets of the business, which is the asset in the middle over there, right? So you go in there and you deduct, you remove that $200, which you need to pay to Joe. Okay, going back to our rule of thumb, before that money leaves the business, it needs to be checked out. And so that money needs to go into an expense account where it's checked out as $200 and off to Joe. Okay, so once again, we have recorded the transaction in two places. First, where it originates, which is the checking account. And in this case, because it's a deduction, it's going out of the business, it's a negative, right? But when that money flows over to the expense account, it changes into a positive. The reason why that is because those two account types are similar, okay? When money flows from one to the other, it changes its sign, okay? That's why you can see it's blue. There are the only two accounts in this sheet that have this blue, right? The assets and the expenses are similar types. And so at this point, we now have all the main buckets that are necessary to tell the financial story for your business from its beginning all the way to when you sell it, these relationships will always stay the same. Okay, so from this point forward, we will talk about what are the different accounts. Now, you would notice, for example, in the liability column, right? We have two recordings there. We have a security deposit recording of $1,000 and a mortgage for 80,000. Now, of course, those are two different types of liabilities. And so it makes sense to have sub-accounts on the liabilities. Although they all behave the same, they should have this different names that properly categorizes every transaction. And that's what we're going to talk about in the next video. So stay tuned.